Hi everyone, friends. We have dealt with the the business combinations wherein we talked about a direct control, wherein an entity did not have the acquirer did not have any stake in the entity, and then they acquired sufficient stake, right, in the other business and assumed control on that. And then we also talked about a scenario wherein the acquirer had some stake beforehand, which was not a controlling stake, and eventually they acquired a further stake wherein it becomes a an acquisition in stage, or a business combination in stage, or a step acquisition, right, as the terms that we used, where we dealt with the accounting for both the scenarios. Right now, what we would want to do is basically we are now looking at the third step in that direction, wherein you already have a control over an entity and there's a change in the proportion, right? There's a change in the proportion of the non-controlling interest. Okay. Put simply, if I say that there is a company X which has 80% stake, let's assume that it is a controlling stake, which simply means that the NCI is 20%. All right. Now, what company X does, it acquires additional stake of, let's say, 15%, right? Now, which means that the overall holding of the parent company, the acquirer, becomes 95%, and the NCI reduces from 20% to 5%. Okay, so how do we deal with that scenario? That is something which is the context we want to talk about. Changes in the proportion held by non-controlling interest, right? It can also, by the way, be in a different direction, wherein we may say that company X had 80% stake. Of course, the NCI had 20% shares, and then company X disposes or sells, let's say, 10% stake. Okay. Now, what would happen as a result of it? It would simply be that the parent company will have remaining 70%, and the NCI's stake changes to from 20% to 30% now. Okay, so we're going to talk about both these aspects, that is change in the proportion. For example, what is held by non-controlling interest, right? Importantly, this transaction or this kind of a transaction is referred to as a control to control situation, or a control to control scenario, right? You're not losing the control. You're not acquiring further control. You already had the control with 80%, for example, in our scenario. Okay, which means that there is no change in goodwill. Okay, there is no change in those net assets for consolidation purposes. When you had assumed control originally with 80%, you were consolidating the entire 100% assets and liabilities of the other entity. Okay, it does not make any difference when this changes from 80 to 95%, or it changes from 80 to 70%. You still control. There's no change in the goodwill. You don't get extra advantage as a business. You're still a part of the same business, right? So the goodwill doesn't change. Of course, what changes is the NCI. Okay, in this case, the NCI is declining from 20% to 5%, and in this scenario, NCI is increasing from 20% to 30%. So it's a control to control situation. This is something which is the takeaway for us. No changes in goodwill, no changes in the consolidation procedure. It remains exactly the same. So let's talk about this aspect there. We'll be taking notes on all these things with the help of a lot of examples, and build that along. So let's look at the concept again. It says that a parent shall present the NCI in the consolidated balance sheet within equity separately from the equity of the owners of the parent. Okay, an entity shall attribute the profit or loss of each component of other OCI to the owners of the parent and also the NCI. We'll be discussing in terms of what all it means, right? This is something that we have dealt with under Ind AS 110, the consolidation, right? In terms of how are the profits of the subsidiary separated or bifurcated between how much relates to the parent and how much relates to the non-controlling interest. The entity shall also attribute the total comprehensive income to the owners of the parent and that of the NCI. It doesn't matter even if NCI has a deficit balance, right? It can happen that the subsidiary is having a loss, so an NCI can have a debit balance as well, right? So effectively, the slide is trying to suggest that when you prepare the balance sheet for the group, right, we are saying that within the main heading, equity and liabilities, right? We're talking about equity. Now, this is all parent, right? Share capital, retained earnings, other equity, and then we are also having a separate line item referred to as NCI. Now, this is the way, this is the manner you present the non-controlling interest in the group balance sheet. That is something which is the perspective shared, right? In the statement of profit or loss, right, we are saying here that this is the group's statement of profit or loss. Just to clarify, we are saying that the revenue of the group, the cost of goods sold, for example, the gross margin, right? And then we have expenses, profit before tax, then we have tax expense, and then we have, of course, profit after tax, within which we want to split how much relates to the parent and how much pertains to the non-controlling interest, right? Similarly, for the OCI also, we do the similar split. This is something which is, again, the presentation requirement, right, on the face of the consolidated balance sheet and consolidated statement of profit or loss. All right. Now, what we are saying is, with respect to the changes, when the proportion of the equity held by NCI changes, an entity shall adjust the carrying amount of the controlling and non-controlling interest to reflect the changes in their relative interest, right? It simply means that the NCI is, for example, in case you are buying additional stake from 80% to 95%, you start viewing the NCI has reduced from 20%. I'm so sorry, from 20% to 5%. So effectively, in this case, we are saying reduce the NCI, you have to debit non-controlling interest, right? It would have been otherwise sitting in the credit only. Okay. To what extent, right? Whatever is the value of that 20% NCI, you simply eliminate out of that 3/4 of the value. Effectively, from a 20%, you are taking away 3/4 of the value, right? And that's why the balance amount is 5%. So we are simply saying whatever is the value of the NCI, right? You reduced 3/4 of the value, and of course, you would have received something from the sale of that, from the purchase of that stake. So from a parent's company's perspective, you are saying that you are acquiring additional 15%, which means that you must have paid something to acquire that stake, right? Whatever that amount is. Let's say, for the sake of argument, my NCI for 20% stake is 5 crore rupees. Okay. Or let's say it is 6 crore rupees. Okay. For the 15% value, we can simply say that this would be 4.5 crores, right? So effectively what I was saying is we debit that 4.5 crores, so that NCI of course is remaining at 1.5 crores. But let's say if I'm paying, for the sake of argument, 5 crores to acquire that 4.5 crore worth of NCI, that would simply mean that there is a additional amount paid, which is a loss, right? But then we don't take that as a part of the statement of profit or loss. We are simply taking it in form of equity. It's a change within the the ownership pattern, right? And any changes in the ownership pattern, purely a change is reflected through the equity, not coming through the statement of profit or loss. And that's what we are trying to say. The entity shall recognize directly in equity any difference between the amount by which the NCI are adjusted and the fair value of the consideration paid or received. If you are acquiring further, then you pay. If you are selling your stake, then you're receiving, and accordingly attributed to the owners of the parent. So this equity, which is the loss in the given case, would pertain to the parent's share of. Okay, let's have a look at this exam. It says that Peter Limited sells its 25% equity interest in Jupiter, which was a 100% subsidiary otherwise, to outside investors in exchange of cash of 2 crore rupees. The carrying value of the net assets is 6 crores, including a goodwill of 1.3 crores, which is arising from Jupiter Limited's initial acquisition. The question is, pass the journal entries to record the transaction. Now, essentially, the NCI here is nil because it's a 100% subsidiary, right? But then the net worth of the business is given at 6 crore rupees, right? And if you are selling 25% stake, the first thing that you want to remember, from 100%, you are moving to a 75% situation, which is a which is a control to control scenario, right? You want to remember that, but it's a control to control scenario. It means that any changes will be reported through equity. Any changes will be reported through equity, right? So what is the change now that we are trying to kind of bring? We are saying that there is an NCI which is arising because earlier you had 100% stake in the business. Now you only will have 75%, which means 25% becomes NCI. Okay. Now, if the worth of the business is 6 crore rupees as per the books, it simply means 25% of that would become the NCI. Okay. But then for that 1.5 crores worth, you are receiving cash of 2 crore rupees, right? What would that imply? It would simply mean that there is a gain, but that would be reported, of course, through equity, not through statement of profit or loss, right? So simply the transaction being 25% stake disposed of. Okay. So it's a control to control scenario. That's why this equity comes in the picture here. Looks perfect, right? Let's have a look at the formal solution as well. It says that the accounting entry would be done, cash or bank, which is 2 crores, NCI, which arises to the extent of 1.5 crores, and the other equity or equity, which is the gain on sale of the interest of 50 lakh rupees, right? Now and onward, whatever is the profit made by the subsidiary, 25% of that profit would now go in the name of the non-controlling interest. That's something which we are obviously looking at as an outcome of this particular transaction, right? Now and onward, the 25% profits or losses will be distributable, to the NCI, and 75% would go to the parent company. Okay, that's a consequence of this disposal of the stake under the control to control scenario. Okay, let's have a look at another question here. It says that Red Limited and View Limited are in pharma industry. 2 years ago, Red had acquired 60% equity stake for 12,000. Okay. At that time, View Limited's fair value was 20,000. Net assets fair value was 12,000. Assume that the fair value and the book value are the same. Goodwill of 4,800 was recorded, which is 12,000 is the amount paid, the purchase consideration minus 60% of 12,000, which were of course the net assets of 12,000 there. On 30th September 18, Red Limited acquired another 20% stake, taking its holding to 80%. So you're moving from a 60% to 80%. That is a control to control scenario, right? The simple question is your NCI, which was 40%, it is now reduced to 20%. That's simply gone by half. That is what you want to remember. Okay. Now, it says that at that time, the fair value of Blue Limited is 40,000 and Red Limited pays 8,000 to acquire the additional 20% interest. At the time of purchase, the fair value of Blue Limited's net assets is 24,000. And the carrying amount of the NCI is 8,000. Okay. Now, importantly, the question's requirement is pass the journal entries to record the transaction. Given so much of information in front of us, what is that we need to pick up? Okay. All I need to remember here is my NCI is declining. So I would say debit NCI. Okay. There is a stake which I'm acquiring. So I'm paying money for that, right? So credit bank for that matter, right? How much am I paying? I'm paying 8,000. So it simply say 8,000, right? The NCI was worth 8,000, but this was for 40%. How much would that be for 20% is simply half of the value, which is, of course, 4,000 now. Okay. That means what? It means that I'm paying 8,000 to acquire something which is worth 4,000, which simply means that I'm paying additional amount, and that becomes a loss to be recorded through equity, right? So I'm simply say being additional 20% stake. Okay. That's all about it. So much of information, all redundant information for my need of my case, right? All I'm picking is the relevant stuff. What is that coming? I'm taking more shares in the other entity. So I'm having a further stake, which means NCI is declining. But since I'm paying for that, so of course bank is involved, and the difference between the two is becoming here, a loss to be recognized through equity there. Okay. Let's have a look at the formal solution. Right? All that's what we are simply seeking here. NCI is reduced by 4,000. Other equity is the balancing figure, which is the loss on acquisition. Of course, you're paying 8,000, so that becomes the cash. Okay. Now and onward again, as the proportion of equity of NCI is changed, the NCI interest would be reduced from 8,000 to, of course, 4,000. Right? Control to control scenario is something that you always want to bear in mind. Okay. Let's have a look at this scenario further. It says that on 31st of March 16, Amar Limited acquires 100% of equity interest in PAL Limited for 1 crore rupees when the fair value of the net assets was 80 lakh rupees. All right. During March 19, Amar sold 45% of the investments in the subsidiary to another entity for 90 lakh rupees. And Amar Limited, after the stake sale, still holds 55% controlling interest. So you're saying that you're moving from 100 to 55, which is still a control to control scenario. Okay, it's a control to control scenario. The carrying value of PAL Limited's net assets is 1.8 crores, including net assets of 1.6 and goodwill of 20 lakh rupees. The question is, calculate the gain or loss on sale of interest in PAL Limited as on 31st of March 2019. What is that you are giving away? You're giving away 45%, right? What is the worth of the business? Is 1.8 crores, right? How much are you getting against that 45% worth? You're getting 90 lakh rupees for that. So very similar question what we have just done a while ago. We are talking about that there is a money which is received 90 lakh. There is a NCI which originates, which is on 1.8 crores into 45%. Now that amounts to, if I were to do this calculation, 81 lakh. That simply means you are making a gain that needs to be reported through equity to the extent of the difference of 9 lakh rupees there. Okay. And that's what we have got. It's a change in the equity. So simply means we are talking about, the gain on sale, which arises, of course, to the extent of 9 lakh rupees. The group's consolidated income statement would not show the gain, but of course it is required or it is credited to the equity portion. That's something we need to kind of pick up there, right? So sorry. If we take a step back on this, we are talking about there is a change in the parent's ownership. The identifiable net assets, including goodwill, would remain unchanged. So we are still controlling. Okay. So for the disposals that do not result in the loss of control, the change in NCI is simply arising with the change in the carrying value of the subsidiary. So we have just done the same, calculations. There is no difference between the two, right? If you look at it, the solution that we have talked about, of course, we are talking about at a group level, right? Wherein we talked about a gain of 9 lakh rupees arising. But if you take a step back, right, we're also referring to the gain on sale of investment in the individual financial statements of the parent company, right? You have sold this stake for 90 lakh rupees, but the cost of investment is worth 45 lakh rupees, which means that in the standalone financial statements of the parent company, there would also be a gain recognized to the extent of 45 lakh rupees, right? That's where you start distinguishing between the separate financial statements and the group financial statements. All right, that's something which is the distinction that you want to carry here. And finally, from the recognition and presentation perspective, this is the same accounting that we did: debit bank, credit NCI. Of course, recognition of NCI comes at 81, and the difference is basically recognized as a gain through equity, of course. All right, now the NCI would be taken at this 81 lakh rupees, and that's how it would be continued. And anything that the subsidiary earns now, right, 45% would relate to, of course, the non-controlling interest. Okay, there's yet another example. Let's have a look at it. It says that on 31st of March 2019, Satya transferred 25% voting rights from its holding in Paul to Mark for 250 crores. It still retains 75% controlling interest. Okay. At the time of the sale, the carrying value of Paul Limited's net assets is 650 crores. Additionally, there is a goodwill that arose on Paul Limited's acquisition. The question is, suggest how Satya Limited should account for the transaction. Now, this is all similar to what we have done so far, right? We're saying it's from 100 to 75. It's from 100% to 75%, which still talks about a control to control scenario or a control to control situation. Okay. When you look at the recovery realization, talking about 250 crores, when you look at the assets, we are given 650 crores of assets and also a goodwill of 100 crores. We can simply look at this entire, calculation as we have done. Basically, the 25% of 750, because the goodwill is not included, it's over and above. So we need to take both 650 plus 100, right? So that becomes 750, 25% of that becomes 187.5. Since you sold that stake for 250 crores, the balance amount becomes the gain, which is of course recognized through the equity. All right. These are all the examples which are pretty much similar, right, across in terms of when you move or when you talk about a control to control situation. Okay. Thank you very much.